The Bank of Canada has once again left its key interest rate unchanged at 2.25%. Homeowners renewing their mortgages and other borrowers breathed a sigh of relief at this widely expected hold, the sixth consecutive one. But the bigger question is, what does it all mean for Canada's economy and what comes next? With a slow start to the year, recent economic indicators suggest the Canadian economy is beginning to strengthen. Growth has picked up, the unemployment rate has edged lower, and global oil prices have fallen from their recent peaks. But there is uncertainty surrounding the conflict in the Middle East. Inflation in Canada remains elevated, and some measures of underlying price pressure have started shifting higher.
Overall, our growth outlook is similar to our April forecast, but the data we've received since April have increased our confidence that the economy is indeed working through this period of global upheaval.
That's Bank of Canada Governor Tiff Macklem talking about the announcement. And while the central bank is staying on the sidelines for now, Scotiabank economists continue to believe it may need to raise interest rates later this year to keep inflation under control. Olivier Gervais is the Director of Modeling and Forecasting at Scotiabank, and he joins Natalie Nanowski to unpack the latest decision, what has changed since the central bank's last meeting, and what the updated outlook could mean for inflation, interest rates, and Canada's economy in the months ahead. I'm Armina Lagaya, and this is Perspectives. Now, here's their conversation.
So I just want to start right off the top. We're recording on Wednesday, shortly after the BOC made its decision on July 15th. And thanks so much for joining us.
Well, thanks for having me.
Yeah, so for those who don't know, you were actually at the Bank of Canada before you came to Scotiabank, so you know what goes into a decision like the one that was made today. Tell us about kind of what happens in the weeks and days leading up to today.
Yeah, so indeed, I spent about 17 years at the Bank of Canada. I started as a young economist and ultimately became director of forecasting in the Canadian Economic Analysis Department before I decided to join the Scotiabank last year. One thing I would say about these decisions is that there's a lot of things that goes into this. Like, you can only see the tip of the iceberg. There's a ton of analysis that goes inside those decisions. You start with near-term forecasts, and then this feeds into the longer-term forecast. There's also global outlook that's done at the same time that feeds into the forecast exercise. And then all of this is presented to the Governing Council. There's a discussion with them. And the monetary policy report gets written at the same time as the staff is doing this forecast. A lot of discussion is going on in the background.
Yeah, so it looks like after all of that analysis, the decision today was that the Bank of Canada decided to hold interest rates for a sixth time in a row. And it seems like their outlook this time around is a little bit more positive than the last. They weren't overtly warning of an increase. And there were kind of three key messages that came out of this. And two of them is that the economy is going to rebound and that inflation is going to ease. What are your thoughts on all of this?
Yeah, so actually the narrative of the bank is actually very close, I think, to the narrative we have at Scotia Economics in terms of growth and inflation. They are indeed expecting GDP growth to pick up, confirming that the weakness we've seen earlier this year was really just a temporary soft patch, like a very soft growth we've seen in Q4 of last year and Q1 of this year, and that the economy is rebounding from that. And, we've been talking about that as well. And in the last monetary policy report, they were saying that, this is their expectation, but there's a lot of risks around that. And the data that came out since then just confirms that. So that's why I think the tone can be seen as a bit more positive than last time. It's just that, the data that's been coming out is confirming that the economy is exiting that temporary soft patch. In terms of the decision, I think it was widely expected. It's the right decision, I think. I liked also the fact that they talked about risks on both sides. Like, there's a lot of risk right now coming from elevated costs, war-related costs, but also other costs in the economy that are pushing up producer prices, and that can ultimately feed into inflation. That's an important positive risk. Actually, we've been talking about that for quite a while as well. So they are talking about that. They're also talking about negative risks, especially on the growth side. of things. In particular, on exports, they are expecting an important increase in export growth next year. And they are talking about, there's risks around that. So if you have weaker growth, then that would weigh on inflation. But at the same time, if you have higher costs, that could, push up inflation. So they're really trying to balance those things out.
Mm-hmm. And another main reason, well, you kind of mentioned it there, but a main reason for some of the optimism has been that Canadian companies have shown to be resilient and that exports are growing. What does this all mean for the economy?
Yeah, so one of the reasons why at the end of the day, firms are kind of optimistic is that, first of all, yes, CUSMA, there's risks around CUSMA, but it still protects most Canadian exports from these tariffs. There's some sort of an umbrella protecting them. This is the first thing. The other is that, they are trying to diversify their markets. They're successful in that. So I think that's why, it's possible that indeed exports could rebound in the near term and in the longer term as well.
Mm-hmm. So the war in Iran has had a huge effect on oil prices, but it's something that we've been dealing with kind of since the end of February, beginning of March. And at this point, the public seems to be kind of used to the unpredictability of the situation. Have markets and the economy also absorbed this shock, or is this something that's still having a real and significant effect on inflation and the BOC's decision?
Yeah, so it is definitely impacting inflation at the moment. We've seen gasoline prices rise right away. This feeds into total CPI inflation right away. Gas prices are notoriously easy to adjust. When oil prices go up, you see gasoline at the pump go up right away. So that's like a direct effect. The indirect effect is a lot more subtle. So when oil prices goes up like that, it feeds into costs for firms, transportation costs, for instance, and that can have an effect on consumer prices at the end of the day. But that takes a lot more time, and it depends really how long the war in Iran lasts and how long oil prices stay elevated. So this is a key uncertainty, actually, that the bank emphasized today. And, it's also a key uncertainty on our outlook as well.
And the other element of uncertainty, of course, is CUSMA.
Yes.
We know that negotiations are supposed to be underway. We also know that the administration decided not to extend the agreement with Canada and Mexico. How much of an impact is CUSMA or the renegotiation going to have on our economic outlook?
So our view is that ultimately the deal will get reviewed and renewed, but in the near term, the deal is still in place and still protects Canadian exports from elevated tariffs. So in our view, it doesn't change that much our outlook for exports and GDP growth in general. It does, however, add some risks. If the US really decides to pull out next day to tomorrow, that's a problem. That's going to weigh on economic growth. It does add some negative uncertainty, that's for sure. But at the same time, we believe that this deal is going to get renewed because it's mutually beneficial for both countries, and that it's in their interest, it's in our interest to have it reviewed. But of course, there's going to be some bumps along the way.
So those are some of the two things that the Bank of Canada is really watching out for. But some of the positives we saw in some of the numbers coming out right now is that Canada's unemployment numbers are improving. In June, the country added about 18,000 jobs, bringing the unemployment rate down to about 6.5%. Put this into perspective for us. How much of a predictor is this going to have on the overall situation of Canada and Canada's economic growth?
There was definitely some very good news on the labor market in the last two reports. I think in May, we had very, very strong growth as well. This is suggesting that the economy was really going through some very weak growth at the end of last year and at the start of the year, and that it's picking up. Remember that the labor market actually was quite weak in January. We had some very bad release on the labor force survey. So this strength that we're seeing here is just confirming that the economy is exiting this temporary soft growth. And it's not necessarily a predictor, but I would say it's an indicator that economic growth is picking up.
So when Canadians go to the grocery store, they're seeing inflation kind of in real time with grocery prices going up. How closely is the Bank of Canada monitoring inflation right now?
Well, yeah, they are monitoring it quite closely for sure. That's their job. So they want to keep price stability in Canada. So they are going to follow that very, very closely. At the end of the day, the Bank of Canada is a CPI targeter, so they want to keep inflation under control. So with the oil prices, go up again and CPI go up again, and see the impact of these elevated prices of other goods, then that's not really good. So they will act based on that. At the same time, if oil prices start to fall very quickly and growth starts to weaken, then we're in a different world. It's not something we think is going to happen at all. It's not our base case at all, but that would be something that could lead the Bank of Canada cut. But that's really not what we expect.
What would it take for grocery prices to go down in Canada? Is that something that's even possible?
Prices going down is hard. Inflation going down is possible. So inflation, remember that inflation is the growth rate of prices. So increases in food prices slowing down, that's a possibility for sure. But for that, you would need to see energy prices falling. You need to see commodity prices in general, non-energy commodity prices falling. That's a possibility. Again, it's not really our base case, but it's possible.
So the other big thing I think that everyone talks about when the Bank of Canada makes an announcement is housing. What's Canada's housing situation looking like right now?
For housing, we think it's important to take a bit of a step back and think where the housing market was to know where it's going. So yeah, we've seen a lot of weakness in the housing market in the last couple of years. Why? Well, we had very high interest rates that really weakens this market significantly. Then, as rates cuts were happening, this was supposed to help the housing market. But at the same time, we were hit with trade policy uncertainty, economic uncertainty in general. So when you have this, it's not really a good time to go in the housing market and buy a new house. And at the same time, we had population growth stop completely. We had very strong population growth, and then it stopped completely. So all of these things are kind of have weight on the housing market. Now, going forward, we think this has kind of turned right now, and we are more on the upside. We think the economy is indeed improving. When the economy improves, labor market improves, income improves, income prospects also improve. So people are getting back into the market. And we also have some new policies like the HST rebate in Ontario that will definitely help the Ontario market. So that's why we think that there's going to be a bit of an increase in housing demand. That being said, we don't expect this to really have a big impact on house prices itself, because you've also seen a big increase in supply. Housing starts have been very healthy in the past couple of years, and those new units are coming in the market. So this increase in demand is actually required for prices to stay at current levels. So that's why we think that house prices are going to basically be increasing, but just a little bit in the near future, very far from what we've seen in the pandemic.
A lot of Canadians have their mortgage coming up for renewal in the coming months. What do you suggest Canadians do? Is it better to go fixed? Is it better to go variable at this time?
Yeah, so this is a difficult question to answer because it depends really on the situation of anybody. So it's not something you can tell like everybody should go fixed, should go variable right now. It really depends on your financial position, on the risks also you're willing to take. If you go variable, there's of course you're going to have a bit of a better deal, but there's more risk attached to that. So are you willing to take that risk, and is your financial situation able to take that risk? Fixed rates are there for a reason. It offers comfort, but of course they're a bit more expensive. So all of these things is hard to answer, globally. So it really depends on your personal situation. But on our own forecast is that the policy rate will increase twice this year and once next year. So that will mean that variable rate will probably increase as well.
It sounds like you said that we're anticipating 3 hikes in the coming months. Can you just expand on that a little bit? Or is that going to be up 75 basis points then?
That's right. Yeah. So that's our forecast right now. And, to understand why we think rates are going to go up, is important to understand where monetary policy is at the moment. Rates are a bit in the stimulative mode. So it means that rates are low enough to stimulate growth. Okay, so as the economy gets into better balance, as economic growth picks up, well, you kind of have to remove some of that stimulus going forward. Now, the speed of that is depending on how fast the economy improves. But also it depends on where inflation is going, what are the risks. So like the long-term trend or the long-term force is that it has to like remove a bit of monetary stimulus by increasing interest rates. But we think it's going to happen a bit faster than that because we see a lot of risk on the inflation side. We talked about the fact that the Iran war is pushing up costs. It's not just the Iran war. We've seen prices going up before the Iran war, and we see right now like costs that producers are facing is quite high. That generates a lot of inflation risk. So if you're a central bank and you try to, again, make sure that inflation is under control, you may want to lean against those type of risks in the near term. So if indeed we start to see some upside risk to inflation, we think that the Bank of Canada will try to raise rates sooner rather than later in order to lean against these upside risks.
The next Bank of Canada update isn't until September. What can we expect from them then?
In September, we don't think there's going to be any change. They're going to update Canadians on the state of the economy, where inflation is, where the economy has been, how the economy has been evolving since the last decision. But we don't think they're going to change rates really in September.
Okay. So from everything that we discussed today, what do you think is the big takeaway for Canadians?
Yeah, so I think that today the big takeaway is that the Bank of Canada kept the policy rate unchanged at 2.25, and that was basically expected, totally in line with what we thought. The bank emphasized the fact that the economy is showing signs of improvement, in confirming that the economy is exiting from the temporary softness we've seen earlier in the year. It also talked about inflation being currently elevated because of gasoline prices, but that inflation would actually go back down if indeed oil prices normalize. And he talked a lot about upside risk and downside risk. On the upside, they see risk coming from war-related cost pressures feeding into inflation. And on the downside, they see negative risks on growth that could bring down inflation. So they try to balance those things out. And they think right now that policy rate is appropriate, which makes a lot of sense.
Okay, so let's leave it here for today. Thank you so much for all your insight.
Thank you very much. Thanks for having me.
I've been speaking with Olivier Gervais, the Director of Modeling and Forecasting at Scotiabank.
The Perspectives podcast is made by Ryan Clark, Natalie Nanowski, Ned Kelly, and me, Armina Lagaya. For a transcript of this episode, as well as other stories, videos, insights, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.